Welcome back to American Money, your ultimate guide to mastering personal finance and building wealth. Today, we're discussing GARP investing, growth at a reasonable price investing. Welcome to the GARP Masterclass. I'm excited to spend some time today diving into one of the most effective and time-tested investment philosophies available. The name GARP stands for Growth at a Reasonable Price. As the subtitle suggests, our goal today is to outline a disciplined approach to finding durable growth at a sensible price. For decades, the investment world has been polarized between growth investors who chase fast-growing companies, often at high valuations, and value investors who seek deeply discounted stocks regardless of their growth prospects. GARP is the elegant solution that seeks to bridge that gap. It's a strategy that looks for companies with strong, sustainable growth, but insists on buying them only when their valuation is attractive. Throughout this presentation, we'll break down the core principles of GARP, explore the key metrics used to screen potential investments, and discuss how to apply this disciplined approach to build a more resilient and profitable portfolio. Before we define GARP, we first need to understand the traditional divide in the investment world, which we call the investor's dilemma, choosing between two extremes. On one side, we have the lure of growth investing. This style is captivating because the goal is to identify stocks expected to grow at an above-market rate. These are the innovative companies, the disruptors, the ones whose products everyone is talking about. The focus is purely on capital appreciation, betting heavily on future, often distant profits. However, the associated risk is significant. Share prices can be highly volatile. Investors often pay a premium for these high-flying stocks, meaning they are built on lofty, uncertain forecasts. If those forecasts don't materialize, the crash can be painful. On the other side, we have the discipline of value investing, pioneered by figures like Benjamin Graham and practiced by Warren Buffett. Here, the goal is to find opportunities the market has underappreciated. The focus is on buying stocks trading below their intrinsic value. They want a bargain. But the corresponding risk here is the value trap. Cheap stocks are often cheap for a reason. Investors risk being caught in a company with bleak prospects that never recovers, and the stock price stagnates or continues to decline. So the dilemma is clear. Do you chase the exciting, volatile growth stocks, or do you commit to the undervalued, potentially stagnant value stocks? GARP offers the middle road, seeking the best attributes of both worlds while mitigating the extremes of volatility and stagnation. This slide finally brings us to the core of our masterclass, GARP, a hybrid strategy for the best of both worlds. As the definition on the slide states, growth at a reasonable price, GARP, is an equity investment approach that combines the offensive features of growth investing with the defensive discipline of value investing. Think of this Venn diagram. On the left, we have the growth circle, characterized by strong growth prospects. This is the offensive feature, the ability of a company to expand its earnings and revenue rapidly. On the right, we have the value circle, which requires reasonable valuations. This is the defensive discipline, the requirement that we don't overpay for the growth. The sweet spot, the intersection right in the middle, is GARP. It focuses on maximizing capital appreciation while building in a necessary margin of safety. Simply put, the strategy aims to find companies with strong earnings growth potential while strictly avoiding those that are overpriced. The key takeaway is that by blending these styles, GARP creates a balanced portfolio with both opportunistic and defensive characteristics, making it more resilient and effective across different economic and market cycles. It's not about being the fastest growing or the cheapest stock, but the optimal combination of both. To truly understand the GARP mindset, we must look to the great investor Warren Buffett. His famous quote perfectly captures the essence of this strategy. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This quote is the philosophical foundation of GARP. The wonderful company is the growth element. GARP investors, like Buffett, focus on the quality of the business. Companies with strong competitive advantages, sustainable business models, and a history of consistent growth. We are not looking for risky, highly speculative ventures. We are looking for durable, high-quality businesses. The fair price is the value element. This is where the discipline comes in. We understand that a wonderful, high-quality company will almost always command a higher price than a struggling or mediocre one. Unlike pure value investors, GARP investors are willing to pay for growth, but they are skeptical of paying any price. We look for opportunities when the market offers these high-quality stocks at moderately inflated or reasonable valuations. This leads to a crucial distinction from pure growth investing. GARP investors are skeptical of the lofty growth forecasts, like plus 25% year after year. Instead, they seek more realistic, sustainable growth rates, typically in the 10 to 20% range. This focus on realistic expectations is what builds in that margin of safety. In short, GARP is a quality-first strategy. We'd rather own a phenomenal business at a slightly higher price than a mediocre business that is dirt cheap, as the mediocre business carries the inherent risk of the value trap we discussed earlier. The theory and philosophy behind GARP sound compelling, but the true test of any investment strategy lies in its performance. This slide provides the proof. GARP has delivered superior long-term returns. This chart illustrates the cumulative returns of GARP stocks versus the S&P 500 index over nearly 3 decades, from January 1, 1995 through December 31, 2024. The analysis, conducted by T. Rowe Price and based on FactSet data, tracked a proprietary equal-weighted basket of GARP stocks identified from within the S&P 500. As you can clearly see, the GARP basket, the gold line, has generated significantly higher cumulative returns than the broader S&P 500 market, the dark blue line, over this 3-decade period. While the market index has certainly delivered strong returns, GARP's disciplined approach to combining quality growth with valuation sanity has allowed it to compound capital more effectively, resulting in substantial long-term outperformance. This evidence is crucial. It shows that by applying the GARP principles, seeking wonderful companies at a fair price, you are not just adopting a safer or more balanced strategy, but one that has historically proven to be one of the most effective paths to long-term wealth creation. If the P/E ratio is the metric of value investors and the growth rate is the metric of growth investors, the PEG ratio is the invention of the GARP investor. It is the core metric, gauging growth versus price. As popularized by legendary fund manager Peter Lynch, the PEG ratio is the primary tool for determining if a stock's price is reasonable relative to its growth expectations. The formula is simple but elegant. PEG ratio equals PE ratio divided by annual EPS growth rate. Since both the numerator, PE, and the denominator, growth rate, are percentages, we are essentially asking, how many units of price are we paying for 1 unit of growth? Let's look at how we interpret the result. PEG greater than 1. This suggests the stock may be overvalued. You're paying more for the earnings than the company is expected to grow. PEG equal to 1. This suggests the PE ratio is in line with earnings growth, meaning the stock is fairly priced. PEG less than 1. This is the sweet spot for GARP investors. It suggests the stock may be undervalued, as its price is not fully reflecting its earnings growth. Here is a practical example. A company with a PE of 15 and an earnings growth rate of 20% would have a PEG ratio of 15 divided by 20 equals 0.75. A PEG of 0.75 makes it highly attractive for further analysis because you're buying 20% growth for a multiple of only 15. This is the power of the PEG ratio. It automatically flags companies that are growing quickly but have somehow been overlooked or undervalued by the market, ensuring that we never overpay for future prospects. Now we shift from philosophy to practicality. To find those wonderful companies at a fair price, we need a scorecard of specific financial metrics. This slide outlines the GARP scorecard. GARP investors primarily rely on three categories of metrics: growth, value, and quality or profitability. Number 1. Value and growth combined, the PEG ratio. The single most important metric for GARP is the price to earnings to growth, or PEG ratio. This metric perfectly combines the growth and value elements. The PEG ratio is the stock's PE ratio divided by its expected annual growth rate. A key rule of thumb, popularized by Peter Lynch, is to look for a PEG ratio of 1.0 or lower. A ratio of 1.0 suggests the stock is currently undervalued relative to its growth potential. Number 2. Valuation, next 12 months PE ratio. For valuation, we use the next 12 months price to earnings ratio. NTM-PE uses the current share price divided by the estimated earnings per share for the next 12 months. We prefer this forward-looking ratio because it gives us a picture of what the company is projecting to achieve. While pure value investors want a very low PE, GARP investors seek a moderate PE, typically in the 10 to 20x range, or one that is meaningfully lower than the broader market average. We're willing to pay a little more than the market average, but we must avoid the extremely high PE ratios of speculative growth stocks. Finally, for quality, we look at return on equity, or ROE. ROE measures a company's net income relative to its shareholder equity. It tells us how efficiently a company is generating profits from the capital provided by its shareholders. GARP investors look for high and sustainable ROE, ideally above the industry average. A high ROE signals a well-managed business that effectively allocates capital and can reinvest profits to drive future growth. We've established that GARP has delivered superior long-term returns. Now let's look at why it works. The reason can be summarized by the advantage: paying less for more profitable companies. This slide shows two powerful charts that track the characteristics of a typical GARP basket compared to the S&P 500 over 25 years. Chart 1. Valuation advantage, NTM-PE ratio. Remember, this is our forward-looking valuation metric. Notice the S&P 500, the dark blue line, consistently trades at a higher PE, often fluctuating in the 15 to 22x range. In contrast, the GARP stocks, the gold line, have consistently traded at a meaningful discount to the broader market, typically sitting between 12x and 16x. This demonstrates that GARP stocks have consistently traded at a meaningful discount to the broader market. You are essentially paying less for future earnings compared to the average stock in the index. Chart 2. Quality advantage, return on equity, or ROE, our key quality metric. Now look at the right chart, which tracks return on equity, or ROE, our key quality metric. The S&P 500 ROE, dark blue line, is consistently lower, averaging around 13 to 15%. However, the GARP stocks, the gold line, have typically offered significantly higher return on equity, or ROE, generally staying above 18% and often exceeding 20%. Higher ROE is a direct indication of greater profitability and more effective capital allocation. These are simply better run businesses. Putting this together, the core GARP advantage is clear. The data demonstrates the opportunity to buy shares of more profitable and better managed companies at a material discount. You get higher quality at a lower relative price, which is the engine of its long-term outperformance. We've covered the philosophy, the metrics, and the historical performance. Now let's get into the mechanics of building a GARP screen, a simple filter-based approach. A screen is the first step in the research process. It uses a series of absolute filters to narrow the universe of thousands of stocks to a manageable list of high-potential candidates. The table on the slide shows a standard example of a simple, effective GARP screen. Growth filters, ensuring a wonderful company. We first apply growth filters to ensure the company has a proven track record and solid forward-looking prospects.
EPS 5-year average, percentage greater than 15. This proves a track record of strong earnings growth. Sales 5-year average, percentage greater than 10. This ensures consistent top-line expansion, proving the demand for the business is real. Estimated EPS change next year, percentage greater than 15. This filter focuses on solid forward-looking growth expectations. Value filters, ensuring a fair price. Next, we use our value metrics to make sure we aren't overpaying. Earnings yield, percentage greater than 5. This is equivalent to a PE ratio of less than 20. It's a quick way to ensure we avoid excessively expensive stocks. PEG, forward, less than or equal to 1.1. This confirms the price is reasonable relative to future growth. We set the bar at 1.1 to capture stocks that are just slightly above Peter Lynch's magic 1.0 rule. PEG, trailing, less than or equal to 1.1. This confirms the price is reasonable relative to past growth, giving us confidence in the historical numbers. By applying these filters, you quickly reduce your search from thousands of stocks to a handful of strong candidates that satisfy both the growth and value criteria simultaneously. Crucially, screening is merely the first step in the research process. It generates ideas, not buy orders. Detailed due diligence on individual companies, such as examining their competitive moat and balance sheet, is essential before investing. While the basic filter screen we just reviewed is a powerful starting point, sophisticated GARP investors often refine their process with advanced techniques, screening for trends and relative strength. We move beyond static numbers and incorporate methods that identify the best all-around companies and ensure they are moving in the right direction. 1. Equation-based filters, identifying positive trends. First, we use equation-based filters. The concept here is to filter, not just on a single number, but on the financial trends and directionality of the metrics. Instead of just looking for, say, 15% EPS growth, we use a more rigorous concept. You want the current year's EPS to be greater than last year's EPS, and last year's EPS greater than the last 2 years' EPS. This ensures the company is showing consistent acceleration, not just an average number. For example, we would screen for estimated EPS growth, estimated sales growth, and other key financial metrics that show an improving year-over-year direction. This helps us avoid companies that had a great 5 years but are currently slowing down. 2. Ranking, or weighted screening. Second, we employ ranking or weighted screening to find the best all-rounders. The goal is to move beyond the simple pass-fail nature of basic filters. Instead, we assign a weighted score to each metric based on its importance. For example, we might weigh the PEG ratio and return on equity highest, as they are the core GARP principles. We'd give less weight to trailing metrics and more to forward-looking estimates. This process allows the system to identify companies that are highly successful across all GARP metrics, even if they fail one minor filter by a small margin. This prevents us from missing great companies because they had one metric slightly outside our absolute filter. By using these advanced techniques, you elevate your GARP screening from a basic checklist to a highly refined process for selecting premium, high-potential investments. We've seen the data. GARP stocks are more profitable and yet trade at a discount to the broader market. The key question is, why? Why does this opportunity persist? The answer lies in a durable inefficiency. Why is there no natural buyer for GARP stocks? GARP stocks are often systematically overlooked by the major investor archetypes, creating a consistent opportunity. Pure growth investors. These mandates require high top-line revenue or EPS growth, often exceeding 25%. They often dismiss GARP stocks because their steady, less explosive growth, typically in the 10 to 20% range, is considered insufficient for their aggressive targets. Pure value investors. For these investors, GARP stocks look too expensive. When true deep value sectors like financials or energy are trading at 11x to 13x PE ratios, a GARP stock at 16 to 22x PE ratios represent an untenable premium. They focus purely on the deep discount, ignoring the underlying quality and growth. Hedge funds and speculative retail. These investors tend to prefer names with higher volatility and greater near-term upside potential. They're looking for quicker, more dramatic returns, which often means chasing the highly speculative or deeply distressed stocks, not the steady all-rounders. The gear image in the middle illustrates this perfectly. The capital flows from these three major investor groups bypass the GARP stock because it doesn't fit neatly into any of their strict mandates. This lack of a natural constituency is what causes GARP stocks to frequently trade at a discount to their intrinsic value. This is the durable inefficiency that allows disciplined GARP investors to consistently capture alpha. To bring everything together, this final slide provides the GARP Investors Checklist. This is the concise, 6-point summary you can use when evaluating any potential investment to determine if it fits the GARP criteria. A true GARP stock must satisfy all 6 of these points. Profitable business. The company must already be profitable, not a speculative venture. We are investing in present success, not just future hopes. Consistent growth. We look for historical and forecasted future profit growth in the 10 to 20% range. This is the realistic, sustainable growth that avoids the high-risk speculation of pure growth investing. Reasonable PE ratio. The PE ratio should typically be in the 15x to 25x range, ensuring we are avoiding speculative highs. Low PEG ratio. The PEG ratio should ideally be below 1.0, which is the crucial metric signifying that growth is not yet fully priced into the stock. High profitability. Key quality metrics like return on equity, or ROE, and return on invested capital, or ROIC, must be above the industry average. This indicates a truly superior business model and efficient management. Solid financials. Finally, the company must have a strong balance sheet with manageable debt. This provides the defensive margin of safety that protects capital during market downturns. By using this checklist, you adopt a disciplined approach that seeks the best characteristics of both growth and value, setting you up for superior long-term returns. We cannot discuss the GARP strategy without paying tribute to its most famous pioneer, Peter Lynch. Peter Lynch is synonymous with the philosophy of growth at a reasonable price, and his track record remains one of the greatest in modern finance. His key accomplishments include manager of the Fidelity Magellan Fund from 1977 to 1990. He achieved an average annual return of 29.2% over 13 years, consistently outperforming the S&P 500 and making Magellan the best-performing mutual fund in the world during that period. This is the ultimate proof of GARP's effectiveness. He is the investor who popularized the GARP strategy and famously championed the use of the PEG ratio, which we established as the core GARP metric. He also authored investing classics like One Up on Wall Street, which remains a foundational text for individual investors. Lynch's success was not built on high finance secrecy. It was built in applying simple, disciplined common sense, the core of GARP. He looked for companies he understood, with sustainable growth, but always insisted on a fair price. His quote at the bottom summarizes the behavioral discipline required for all successful investing, especially GARP. The key to making money in stocks is not to get scared out of them. By focusing on quality and buying at a reasonable price, GARP builds in the margin of safety needed to stay invested even through volatility. We have proven that GARP delivers superior long-term returns, but its true power is revealed during times of market stress. This slide highlights why GARP is built for all seasons, its performance through market turmoil. GARP's blend of quality businesses and reasonable prices provides a crucial downside protection and faster recovery, leading to demonstrably better risk-adjusted returns. Better risk-adjusted returns. The Sharpe ratio measures return per unit of risk. GARP stocks have a Sharpe ratio of 0.66, significantly higher than the S&P 500's 0.47 since 1990. This means GARP investors are rewarded with far better returns for the level of risk they take. Less downside. The strategy exhibits minus 17% less downside capture than the S&P 500 during negative periods since 1990. In simpler terms, when the market falls 10%, GARP stocks tend to fall only 8.3%, thanks to that built-in margin of safety. Faster recovery. When the market turns around, GARP stocks recover faster. They take 54% of the time it took the S&P 500 to recover from drawdowns to previous peaks since 1990. This quick bounce back is key to compounding returns over the long term. We see this performance validated in two major crises. Dot-com bust, 2000 to 2001. GARP stocks outperformed the S&P 500 by 28 and 17 percentage points in those two terrible years. Global financial crisis, 2008. GARP stocks still outperformed the S&P 500 by 12 percentage points. This resilience during crises is the final compelling argument for GARP. By buying wonderful companies at a fair price, you build a portfolio designed to not only perform well, but also to weather the inevitable storms of the market. To appreciate the significance of GARP, we must place it in the context of investment history. This slide shows the evolution of an idea, how GARP bridged Graham and Buffett. GARP was not an entirely new idea, but rather the necessary evolutionary step that allowed value investing to thrive beyond its original statistically rigid framework. 1. Benjamin Graham, Classic Value. Graham's philosophy, shaped by the Great Depression, was to buy fair companies at a wonderful price. His method was strict quantitative analysis, seeking companies trading for less than their net working capital, the so-called net nets. The business itself was secondary to the statistical bargain. 2. Peter Lynch and GARP, the bridge. As markets became more efficient and companies trading for less than their liquidation value, Graham's cigar butt bargains, vanished, a new approach was needed. Lynch provided the bridge, introducing the philosophy that growth is a key component of value. His method blended growth and value metrics, willing to pay a reasonable price for a company with a proven track record of strong, sustainable growth. 3. Warren Buffett, Modern Value. The final evolution, influenced by GARP, was championed by Warren Buffett. His philosophy is to buy wonderful companies at a fair price. His method shifted focus to qualitative factors, like durable competitive advantages or moats and the quality of management. In summary, GARP provided the critical link. It modernized the value framework by recognizing that a great business is worth a modest premium, paving the way for the modern value investing that dominates the world today.
So there you have it, a thorough framework on GARP investing. What are your thoughts on GARP investing? Do you have the confidence to implement this investing strategy? Don't forget to like, subscribe, comment, and share if you found this information valuable. Thanks for visiting American Money, and we'll see you in the next one.